Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. I'm Merryn Somerset Webb, and with me once again is Money Distilled author and senior reporter John Stepek. John, can't get enough of you and your meme coin chat this week. But the reason that you, the audience, are joining me for this conversation is we wanted to have a bit more of a roundtable conversation. No, hang on, it's not the audience. I really should have read this before we started. Hang on. But John, the reason you are actually joining me for this conversation, as well as the one we had earlier in the week, is that we want to have more of a roundtable style discussion with our guest this week. We wanted to talk about Rachel Reeves. What exactly is going on in her head? We're trying to figure out what choices she has, given the very tricky fiscal situation she's found herself in, and trying to figure out whether she is beginning to change her thoughts about how she wants to take the economy forward from here. So to help us answer all this and really get into what can be done to encourage growth in the UK, and we're using the word encourage, not create, for a very particular reason, we've brought in Simon French, Managing Director, Chief Economist, and Head of Research at Panmure Liberum. Welcome, Simon. And lucky you are in the studio right there with John today.
I am, and thank you for having me back, Merryn, on the podcast. And I am particularly interested in hearing how much Melania coin John has bought in the last 7 days.
John is useless at this. He doesn't even have a Coinbase account. He doesn't own Dogecoin. He hasn't got any Bitcoin. He hasn't got any Ethereum. I mean, nothing. It's hopeless. Whereas I, on the other hand, am slowly becoming exceptionally rich on the back of my crypto holdings.
We call Merryn diamond hands.
Do I want to know?
That's what I say.
No. Oh, you don't know your hodler from your no coiner.
No, you don't, do you? Simon, I'm guessing that you don't have any Melania coin or indeed any Trump coin.
I am so fiat you would not believe.
Yeah,
and
well,
I've been called other words with similar number of letters and similar first letter.
Well, I tell you what, when the debt apocalypse comes, don't you two be running to me. You've had your chance.
Well, I've got my gold.
I'm stacked up on rice pudding, so I'm all good, thank you.
Oh, well, we'll be fine then. Right, Simon, this is all about you. Well, all about what you think. Anyway, your latest tweet, Simon, by the way, is very active on Twitter. What's your handle, Simon?
At French Economics.
At French Economics. Definitely sign up or follow him if you haven't, because he does tweet lots of interesting things. His last tweet was something you don't hear often these days anywhere. Fair play to the UK government. The penny has dropped on growth and the flurry of announcements on some genuinely thorny policy areas. We're talking airport expansion, orientation of regulators, judicial reviews, AI, life science visas, all this kind of thing, all suggest a change of emphasis from blaming the economic inheritance to getting out of the way of growth. Now, interestingly, when I introduced this and I talked about encouraging growth, not creating growth, I think the three of us probably all start from the same point, which is that it is not possible for a government to create growth. It is only possible for a government to facilitate growth. Is that a fair assumption to start with, Simon?
I think it's a fair assumption of the three people on this podcast, and it's probably a fair assumption of how the economy operates. I think if we're being really candid, and hopefully on this podcast we can be, one of the intellectual inspirations for the missions policies, of which the principal mission is economic growth, Mariana Mazzucato would not agree with us if she was on this podcast, where she does believe that the public sector balance sheet can create economic growth. So there is, while I think we agree, and there's a unanimity on the contributors, it's not necessarily a unanimous view on the people who have the ear of the Chancellor, Rachel Reeves.
Which is something of a shame, isn't it?
Well, it is, but I think if you are cup half full, and I think, again, the three of us try and be cup half full when we look at economic growth, the one thing that can be said about this government from people who are close to them and have seen them, how they've behaved in opposition through their career, is they're relatively fast learners. And What you didn't read out was the second part of my tweet, which is there are some big caveats to the praise, 3 caveats I put in to the praise that I've given the government from its change of tone. And the main caveat is they made a strategic massive mistake over the summer, blaming the economic inheritance, talking about a black hole, talking about the worst economic inheritance since the Second World War. Have they learnt the lesson just in time before animal spirits are entirely crushed? I'd venture there are signs of that, and therefore if you're more constructive, you'd say they've learned the lesson, they've learned what it is to be in government, where words actually have consequences, and therefore have sort of pivoted just in time to keep some of the goodwill. And there was actually quite a lot of goodwill on the 4th of July when they were elected.
Okay, so that's the first bit, that they've really destroyed the vibe in the UK.
I think that's right. Now, look, economists, again, differ on whether vibes are important. And look, some people I have a awful lot of respect for in the economic sphere go, look, a vibe, sentiment, it's not really a material driver of economic growth. I would say, though, what you can see in the data is that we're in quite a unique position post-pandemic, post-Brexit, where, if you like, polycrises, Brexit, the pandemic, the cost of living crisis, the inflation associated with the Ukraine war, has driven up the household savings rate and driven down the propensity of businesses to invest. And to some extent, those vibes, which, in, if you like, normal times are probably not a great driver of economic activity. And I think John has a nuanced view on this. I might want to bring his views in. Not telling you how to run your own podcast, of course, Merryn. But
everyone tells me how to run my podcast.
I wouldn't do it. But I think at this particular juncture in the economic cycle, given that sentiment was improving, given that we know household balance sheets were in pretty decent position and the opportunity was for them to divest of those savings, take on additional leverage, drive consumption and economic growth, that was a big mistake, that destruction of vibes.
Actually, one point I was going to jump in there briefly because I am on the side of the vibes don't matter camp, basically. But I guess the way I would frame it is that there has actually been a material change, particularly since the budget. And the material change is that the budget kicked employers squarely in the face. And it was unexpected. So to my mind, there's no surprise that with employers thinking about, the message from the top, if you are in an office or in a workplace now is we're cutting back. We're going to have to be careful about your pay rises next year. There's a specific reason for the vibe shift, and it's because they're taxing the private sector more, and that plays out to all the people who work in the private sector. Because it makes people more worried about losing their jobs. It makes people more worried about. So I suppose there's a material, practical reason for the vibe shift, and that's definitely the way I think about it. It amounts to the same sort of thing. But yeah, I think that the animal spirits get hit, but they get hit. It's not just talking down the economy, it's the things that they've done as well that don't help. And I think they specifically putting national insurance contributions up on the employer side was a big part of that.
And I think that is correct. And there were two big errors also made in the run-up to the election that boxed them in on tax. And they were the tax lock, the idea of not raising income tax, VAT, and NICs, although, employer NICs, employee NICs. And then linked to that was not raising taxes on working people, opened up the angle to raise employer NICs. So almost it was reverse engineered into a situation where if you wanted to raise significant amount of tax, you really only had one option. That was the first problem. And then the second problem is employer NICs increases in isolation probably wouldn't lead to this negative response from employers. But at the same time, as an employer rights package expected to cost about £5 billion for the wider economy, and increases in the national living wage about 3 times the rate of current CPI inflation, and you are tightening the visa restrictions from the legacy of James Cleverly's reforms last December. That is an awful lot for employers to go to absorb in one go. Now, I began my career as 22 years ago as a labour market economist, and back when we did labour market reforms, you did a local pilot, you did a green paper, a white paper, you tried to understand the behavioural reaction of employers and employees before you then rolled stuff out. My criticism of the government is all well-meaning things here in terms of raising tax for public services, making for more secure employment, but doing it all at the same time feels a real risk of a policy error.
Yes, it was all done at the same time without quite enough thought about how these seemingly well-meaning things would work together.
Yes.
Yeah. This worry here is that there is more to come, that the fiscal rules are going to be breached and that it's going to be very hard for Rachel Reeves to find any way out of it beyond raising taxes further. And that automatically suggests there would be new taxes that would again fall on employers rather than employees.
Yeah, I think that is one of the fears going into the 26th of March, which is when the OBR released their updated economic forecasts and assessment of whether the government will hit its self-imposed, we must always say, self-imposed fiscal rules, and also the 10th vintage of fiscal rules since 1997. So they always change. But the reason I mention the sheer scale of how many fiscal rules we've had over a relatively short period of history is that one of the options available to Rachel Reeves, should she choose, and this is always a delicate balance of credibility versus pragmatism versus political expediency, is whether she changes and has an 11th iteration of the fiscal rules. But there are other options at play. You can do departmental spending cuts, restrict benefit eligibility. You could also hope that the Bank of England helps you out in terms of its quantitative tapering and the liability that has for the Exchequer through the Treasury indemnity. Or, in terms of debt servicing costs, you could hope that the Bank of England is more aggressive with rate cuts and starts to bring down at least the front end of the curve, and that the back end of the curve also responds, although that is probably more driven by events stateside than domestically in the UK.
Yeah, so that's not something that she can control. But let's say we get to the point where it is clear that the fiscal rules are going to be breached. As you say, one of her options is to change those fiscal rules, and that might be the most sensible option at this point. But assuming that she's boxed herself in so firmly, both politically, what would you think would be the other best option for her? Is there you say she can cut spending by changing entitlement to benefits, etc., but that's a tough gig over the short term.
It is a tough gig over the short term. And, the problem that I think a lot of us foresaw, and I'm not being wise after the event, pre-election, is a lot of conflicting promises on tax, on public spending, this phrase, not returning austerity to the public sector. The reality is that good housekeeping of departmental budgets, demanding efficiency savings, shouldn't be a thing when you're boxed in on a fiscally. It should be something every good business does as business as usual. It's as a standard function of taking out. Yeah, absolutely. And so, to some extent, the reason why I focus a little bit on benefits, and let's get into the specifics of this, the eligibility for what used to be known as disability living allowance is now the personal independence payment, PIP. If you speak to opposition, or now opposition, at least until the 3rd of July, they were the government, a lot of their spending plans to hit pretty similar fiscal rules were predicated on really bearing down on sickness and disability eligibility through the personal independent payment, which is projected to really skyrocket over the next few years. And they thought that
has skyrocketed over the last few years. I mean, it's gone berserk over the last couple of years. And there's been this conversation about the extent to which this is related to flaws in the system, the extent to which it's related to the benefits being too easy to claim or able to claim in maybe the wrong way, and the extent to which it's being related to a rise in ill health in the UK, right?
Yeah, and all of those things are, I think, objectively true. Even Tony Blair, who's not renowned perhaps for being a sort of small state advocate, has come out publicly and said, this has gone too far in terms of the eligibility. But also, it's not just PIP itself, personal independence payment. It is the gateway benefits that opens up, which also has a liability for the taxpayer. And but for the avoidance of doubt, if anybody's going, well, it's all making it sound very easy in terms of spending, cutting departmental spending, none of this stuff is easy, be it departmental efficiency savings, be it annual managed expenditure, or AME, which is the part of welfare payments, abolishing the triple lock. Look, all of this stuff is really, really hard politically. I'm not denying it. But let's not pretend that raising taxes is going to be either easy politically or in the best interests of an economy where demand looks, by almost any measure, pretty soft right now.
Let's look at it the other way around then and pretend that the fiscal rules are not going to be broken, so we don't have to worry about these incredibly short-term things and changing the way the UK economy is run based on minor shifts in gilt yields, etc., which of course is ridiculous in itself. Let's say that doesn't happen and talk about the best things that Rachel Reeves could do to really facilitate growth. I mean, I think as a starter point, we should probably say that, as we said earlier, none of us really feel that you can create growth. We feel you can only facilitate it. And if you're going to facilitate it, or at least create an environment in which growth can happen independently, you're talking about making sure that you have low and simple taxes. That's a long-term project. That you have a state that doesn't overbear the private sector. Again, another long-term project. That you have a solid and effective transport infrastructure. Again, another long-term project. A good education system. We kind of have that. Hooray. Reliable and easily accessible legal system. Do we have that? We can discuss. All these things are what you need if you're going to create an environment for growth. These are all long-term projects. Changing any of those things in the UK is not something we can do over a period that might allow poor Rachel Reeves to keep a job. What can she do in the short to medium term to help things along, do you think?
At the risk of triggering John again in terms of economic vibes, I think a North Sea oil and gas licensing would be the first place I would start. Why? Because, you could say, well, the big economic impacts, could be, for example, rejoining the customs union or the single market. But the political uproar that would create seems like that is off the table. So let's look at practical short-term measures where you change the narrative about the government, ruling out some growth accretive policies on ideological grounds. If you say the world has fundamentally changed from when we were in opposition, where we were against North Sea oil and gas exploration, we have a gentleman now in the White House in Donald Trump for whom we are reliant on his country's exports of liquefied natural gas. Don't listen to Simon French. Listen to the press release of Centrica 2 weeks ago on the madness of the UK swing supply of energy being reliant on gas being transported from 3,000 miles away with a counterparty who, by any objective measure, is only really interested in himself and maybe the broader US economy, and therefore is not going to do any favours in a situation where potentially to his strategic advantage would limit that supply. Securonomics, we don't hear much about Securonomics anymore, but we did pre-election, is entirely consistent with having more domestic energy supply. Now, you may be uncomfortable with the carbon footprint implications of that, but you're consuming it anyway, but you're adding to the carbon footprint by getting it shipped across the Atlantic or brought over from Qatar. That is economic madness. But the short-term economic impulse of that is relatively small. But as a signal that you're prepared to sacrifice some of your ideologies because you really think that investment, a secure energy ecosystem, a lower cost energy ecosystem is really important, that sends a really powerful message to the private sector who may be looking to deploy capital and going, actually, this government is pragmatic, not ideological.
Yes, I agree with that entirely. And that, again, is a material change, arguably.
It's a material change. I mean, Merryn, on tax as well, you mentioned tax.
Yes.
I mean, there's a 78% marginal tax rate through the excess profits levy on North Sea oil and gas profits. I understand politically why that's very, very popular. But look, I'm not a massive Lafferist. I don't think Laffer has much to say around most of our tax rates. But on that, I think there's very strong empirical evidence that actually reducing the tax take actually does bring in more revenue because you just get more investment, more domestic production. You will increase the tax take, not just from the tax take for the Treasury, but the decommissioning budget, which of course goes up, the more existing production just can't be extended its lifespan and the liability comes back on the taxpayer and the exchequer. If you extend licensing and you make a more favourable tax environment, you reduce that liability. So it has a dual-sided positive fiscal impact that can get Rachel Reeves out of a black hole.
But you are a Lafferist, really, Simon. I mean, everyone is, and that, You believe
trying
that
to
there is
trigger me, Merryn. Stop
Come
trying
on,
to trigger me.
you can't deny that with every tax rate, there is a point. There is a point at which you collect less than you would if you had it a couple of percentage points lower. I mean,
agree, and at 78%.
across the board, it's just higher than most people would say. I mean, I would say that with income tax, it comes at around 50%. You know, when you get to the point, one for me, one for you, everyone's like, yeah, do you know what? Maybe we'll just all have less.
Agreed.
So there is a point.
Yeah,
okay.
Absolutely.
But none of these incredibly rational and sensible sounding ideas are remotely possible as long as the British government employs Ed Miliband and is committed to net zero, right?
That is correct.
So not going to happen.
I agree with you, Merryn.
Thank you. I appreciate that. John, do you agree with me?
I mean, I agree on the point. I think it might be changeable. It sort of boils down to a turf war, doesn't it? Because you've got, so Rachel Reeves kind of needs to keep her job for Keir Starmer to keep his job. Whereas Ed Miliband doesn't need to keep his job for Keir Starmer to keep his job. And if Keir's actually ruthless, which I think would be a good thing, I think that would be his most positive trait that I've observed, then he is not stupid and he'll know which one of them's for the chop.
Interesting, because this is also one of the things that we've heard a lot about from both Reeves and Starmer recently is about AI and about data centers and all these incredibly energy-heavy things. And again, this type of drive for growth is very difficult in an expensive energy environment.
Also, actually, just very quick comment to the token Scottish person on the podcast who I believe is you in
is
this
case. Is that me or you?
That's you in this case. Aberdeen's been absolutely gutted by the death of the oil industry in this country. And Aberdeen used to be an important city in Scotland. How come we never hear about it?
Are you suggesting the media is London and South East focused? John?
Well, yeah, but it's not just that. I mean, in Scotland, there must be people up in arms about the end of the oil and gas industry, given that in 2014 it was the primary reason for Scottish independence. I don't really understand why we very rarely hear any mutterings of dissent about the fact that, this entire important capital of the north of Scotland has been entirely deindustrialised by our stupid Westminster-imposed North Sea oil policy.
Yes, but of course, these are things that the politicians in Scotland are all super pro. They're very keen on net zero. They're very keen on getting rid of the gas and oil industry up here. It's a very strange thing. So we hear very little about it because it's one of those things in which the SNP has been in full agreement with Westminster, despite the fact that they're effectively lopping off one of the only successful industries in Scotland.
I'd be interested to see how it works in practice, though, if it ends up coming back.
I just think it will. I mean, as we have said several times on this pod and during our conversations, the global vibe is changing. And so gradually the UK vibe will change. Not that you believe in vibes of.
But just on a broader energy point, look, let's take the data points, which is the UK across the industrial world has the highest cost of energy. There's a lot of areas, and John certainly knows this is a regular theme of my research notes, which is the UK is often pointed out to be exceptional, largely exceptionally negative, when it really isn't. It's middle of the road. But on some benchmarks, it does stand out. And on the cost of energy, it does stand out like a sore thumb. Speak to any energy economist. I'm not an energy economist, but speak to any of them who this is their day job. They will tell you that the future is a pluralistic set of energy sources. It is not hitching your wagon on a single source, either intermittent or otherwise. And that's what I struggle with the idea of ideology driving the energy debate, when the real experts, the true experts in this area, tells you that almost whatever scenario, and none of us have a perfect scenario. I wish we did, although it may put economists out of business if we had a perfect view on the future. But I think most of us can agree that placing your bets across multiple energy sources is certainly the most resilient way to go about having an energy strategy.
And I also think the point about needing it to be kind of homegrown, especially now, is a bit overlooked. An awful lot of this, sort of like the current plan, seems to be based on the idea that we will continue being able to import from Norway and France whenever we can't generate our own wind. And also, as you say, LNG from the US. If we got it in our own backyard, then why aren't we benefiting from the economic activity that getting out the ground will, give us. And also, you can think of it as, what is it? Is it food miles? You can call it energy miles for LNG. We can cut back on those. Absolutely. And the securonomics argument, I think, makes an awful lot of sense on energy specifically.
Let's move on to inflation and interest rates.
Yes.
The conversation around this is constantly changing. Where are you expecting things to go over the next year or so? Thinking about listeners' mortgages.
Of course, we've got 6 rate cuts for this year, which is anti-consensus. And it was a brave call, maybe, that I made earlier in the year. I noted that Goldman Sachs came out with the same call this morning, and suddenly my sales desk at Panmure Liberum took notice, which may question my own personal impact. But the market has moved slightly more towards me. It still only sees 2.5 to 3 cuts, but it's certainly moved away from its arch hawkishness in the first couple of weeks of January. How do I, if you like, intellectually, empirically stack that up? And actually, John gave me, teed this up quite nicely about 10 minutes ago by talking about the fact that a lot of what we've seen in the budget is actually disinflationary. A lot of focus has been on employer NICs being passed through to end consumer prices. And of course, one of the options for companies is to pass it through in end consumer prices. But the Bank of England did a helpful survey back in November that used its decision maker panel to ask them what the companies plan to do in terms of their impact, passing the impact of employer NICs on. And there was actually a pretty even spread between the 4 options available. And one of them is inflationary, higher prices. But actually the other 3 are disinflationary, and they are reduced profit margins, reduced employee wages, and reduced employment. And so in my model, and I think we've started to see MPC members, Alan Taylor, the newest member of the MPC, in a speech last week, which I thought was very good, and Sarah Breeden, both start to pivot towards the fact that this might not actually be the big inflationary impulse, domestic impulse, that I guess has been forefront in investors' minds. And just to show this is not economists and a sort of abstract bit of modelling, always I find in terms of RNSs, so PLCs releasing their financial information, Next is the best in class. I think Simon Wolfson, Lord Wolfson, is brilliant at presenting a breakdown of how his business works. And what were some pretty inflationary impulses through the national living wage, employer NICs, actually, once you take into account all the mitigating actions, including non-wage costs in the supply chain, what is the end expectation pass-through to end consumer prices for this year? Just 1%. And I think to some degree that's, if you like, a real worked example of how I think perhaps overdone was how inflationary employer NICs are going to be, and therefore a slightly less inflationary backdrop, therefore a faster rate cutting cycle than I think the market's currently pricing.
Well, it's interesting you say, like, Sainsbury's has just come out and saying it's cutting 3,000 jobs as a direct result of the rise in costs of the budget. So that's kind of makes your point. Although it's sort of like it's yes, it's good. It's not going to be inflationary. It's not very happy sort of story that it's also going to be terrible for employment.
Absolutely right. Look, if I look at my forecast for the year, I'm more confident than I was, a few weeks ago on the rate path. I'm less confident on the growth path. There are two sides of the coin there, and I recognise that demand, all the indicators on demand, both from employee surveys, consumer surveys, the CBI growth indicator, all the PMIs, of course, purchasing managers indices, are all suggesting a pretty soft demand picture. And therefore, I think the risks that, if you like, we get a sort of technical recession, Q4, Q1, or even Q1, Q2 this year, have certainly grown, albeit I think the second half of the year we'll see a lot of the stuff that the government has spoken about to enable growth. I don't want to trigger Merryn, to enable growth, to get out of the way of growth, will start to sort of come through. And therefore, I think I'm a bit more optimistic on the second half of the year, whether it can make up for what I think will be a pretty soft first half.
You mentioned the impact for the UK of President Trump. in terms of energy. What other impacts might there be for us? I'm thinking about, well, tariffs, obviously, a tax.
Yeah, so on tariffs, the direct impact is relatively contained. So the UK exports about £61 billion worth of goods to the US, which is equivalent to about 2% of our GDP. Compare that to the Eurozone, which exports about $550 billion worth of goods, and that's about 4% of their GDP. So it's half as relevant in the UK as the Eurozone, but it's only a tenth as relevant as Mexico and Canada, which have exports of goods to the US equivalent to between about 20 to 25% of their GDP. So when you benchmark the UK against other major economies, how sensitive they would be to just a uniform tariff across all trading partners, the UK is relatively has limited exposure. But the UK is also quite an open economy, and global growth, the overall impact of tariffs on global growth and activity, does have an outsized blowback on UK economic activity. So I think, direct impact rather less than the market is expecting, but that secondary impact, if it really derails global growth momentum, is where the UK is more exposed, particularly on the services side in terms of economic activity.
But we can't quite forecast an impact, can we? Can't really put in the numbers because we've really no idea what's going to happen.
Much smarter people than I have tried to sort of make sense of this in terms of the quantification on global growth, on tariffs. But we're all trying to guess, aren't we, on the degree to which this is a negotiating position to extract concessions across other policy priorities for the United States, or whether, and there's a other respectable view, which is that Trump 1.0, which had remarkably little impact on the trade balance of the US, had remarkably little impact on global growth, had remarkably little impact on global inflation, is, well, history is the best judge, so it'll be just Trump 2.0 will be the same. There may be different bluster, but it'll have the same material impact. Those are respectable views, both. I think it's just really, really hard to, with conviction, put it into your model for growth, for inflation, and then therefore, by extension, the rate path.
So we'll put that under we don't know.
We have to. We have to, I'm afraid.
Yeah, we do. The other thing I wanted to ask you about, John, you may have other questions before we let Simon go, but I wanted to ask you about the non-existent productivity revolution and where you think there is a possibility for the UK actually improving productivity. And we hear a lot of guff about AI, etc., but we haven't really seen any results yet.
So of all the announcements in the last few days, and look, there've been a flurry of announcements, probably because Rachel Reeves is, as the time of recording, in Davos, speaking to people who like, pro-growth announcements. So look, the grid, the famous number 10 or number 11 grid, has clearly been engineered to make this a growth week. I hope it won't just be a growth week and we move on to other stuff next week. I hope it's a growth year or a growth 4.5 years. But the one thing that did raise my eyebrows this morning is the government's suggestion it will co-opt all the recommendations in a recent review into what I think we could all agree is the overreach of judicial reviews in delaying the cost of capital deployment. And most of the companies we speak to say the UK hasn't got an absence, a paucity of investable propositions, but the timeline and thereby extension, the cost of capital to deploy and the lead-in time to deploy capital is just a big impediment here, and judicial review being an element of that. So anything, and if this is material, and they will recommend all the co-opt all those recommendations to limit the scope and the duration of judicial reviews into critical national infrastructure, that feels to me like a crucial development, which, when you're talking about productivity, does have, I think let's not pretend it's going to be short term, but over a medium and long term view, it's much more constructive backdrop for productivity growth in the UK.
Interesting. John?
This is going back to fiscal rules and policy making. Do you think there's any chance that this might be the government to get rid of or sideline in a helpful way the OBR? And it's sort of just it still blows my mind that the OBR was invented 15 years ago by a Tory government to rub the kind of noses of the outgoing Labour opposition in their failure post-2008. And now it's been used by a Labour government to rub the Tory noses in it. And it has hamstrung them all for the last 15 years. And it just seems madness that we have this sort of like very recently born quango dictating to our politicians how much they're allowed to spend, or else something awful is going to happen.
Merryn, you're not in the studio, so you can't see that John is dressed up as Liz Truss, but I can assure you he is adorned from head to toe in Liz Truss attire.
That's my green uniform.
He has always been a fan.
Look, for the avoidance of any doubt, I get lots of stuff wrong, but I did write a column in I hope a reasonably respectable broadsheet newspaper that talked about the moment of peak OBR omnipotence, which seemingly was just ahead of the election when Rachel Reeves was talking about greater powers. I wrote a column saying, actually, I think that is the moment of peak risk, paradoxically, for the OBR, because when it performs what is seemingly a blocking function for both sides of the political aisle, you might get political consensus that its role needs to be reviewed. So while I don't think the markets are in a position for, if you like, a left field announcement on scaling back the OBR's role in arbitrating over fiscal rules, I do think over time we will see, if you like, bipartisan agreement that it is a little bit crazy, albeit no fault directly of the OBR. It's a fault of what the mandate they've been given and the Charter of Budget Responsibility. We will see a scaling back of that, because I think politicians on both sides will say, from very, very different starting positions, this is getting in the way of good long-term policy making, albeit the OBR would clearly argue in counter, we'll change in that case the fiscal charter, or the Charter of Budget Responsibility that we have to operate to.
That sounds good.
There is one more thing that we must talk about before we let you go, which is the UK stock market.
Yeah.
And you've written in the past, or certainly we've talked in the past, about the idea that UK pension funds should be obliged to invest in UK assets in a similar way to those in, say, Australia, Canada, etc. Pension funds having such a small percentage of their assets in the UK at the moment. And you suggested this would be one way to save the rather miserable UK stock market. That's still your view, I assume. Yes,
albeit I hope I am not tin-eared and haven't seen the sort of quite violent pushback against mandation and not just at a political level, but also in parts of corporate UK. Some of the wealth managers very vocally anti this approach to changing allocation using mandation. So maybe the pensions review in its second stage, it had its interim report with the Mansion House speech back in November, will look at fiscal questions, which they've been told to not address fiscal questions, i.e., the tax incentives to own UK assets. But I think we can both agree with 27 years of data behind us that the removal of dividend interest tax relief in the late 90s accelerated that allocation away from the UK. And you mentioned in your intro to that question, Australia. Their equivalent of dividend interest tax relief, frank dividends, is one of the reasons why Australian pension funds are 40x their overweight their own domestic market, because it's made fiscally attractive to do so. Now, the personalities leading the pension review have changed. It was Emma Reynolds. She's been moved because of Tulip Siddique's resignation to a different role. She's now doing City Minister, and Torsten Bell is now Pensions Minister. It remains to be seen whether Torsten, who has some interesting views on the broader pension savings ecosystem, what his view is around the allocation to the home market and the impact that has on the cost of capital for UK companies, on investment, on the tax base. A lot of the things that we've said are reasons why the UK has gone too far in terms of underallocation to its domestic market.
That's interesting in the Humphrey from Yes Minister context there, I believe.
Don't tempt me, John. Don't tempt me.
We might save that for after we've finished recording. Simon, you're absolutely wonderful. We love having you on. Thank you very much. I'm going to ask one last thing of you before you get to go.
Anything.
Do you by any chance have a favourite book you would like to recommend to our listeners? One that is something to do with investing or finance, obviously, or even politics, or not actually. Just, something appropriate. That's all.
So the one I'm reading at the moment, so it's front of mind. I'm not a big reader of books, but I was away over the weekend.
God, you are down with the kids.
Well, I know. But I was reading one on effectively digital detox. And the name is escaping me. This is terrible. I'm reading a book and I can't remember the title. But in effect,
we'll get it later and put it in the show notes.
Can you please do that? But the idea that you've got just so many apps, and I'm guilty of this on your phone, that the doom scrolling environment just has a really unhelpful and actually, let's make it about economics. It has massive diminishing marginal utility every additional scroll you do, and therefore optimizing that, not some completely going anti-technology or anti-smartphone apps, the huge productivity advantage that has, but actually recognizing that there is a bliss point, and most of us are the wrong side of that bliss point. Yes. And it's just made me think a little bit more about what apps are absolutely essential on my phone and which I need to get off or have sort of time limits or little cues to change my behavior of engaging with that. So that will be one that, if you can put in the show notes, it's a really good book, which I'm about 3/4 of the way through, and it has genuinely changed my behavior and how I consume information.
Okay, brilliant. I need that. What with, being on Twitter while you've been talking. Joke, I haven't. Not really.
God, I'm so verbose, aren't I? Maybe you're scrolling while I'm answering your questions.
Thanks for listening to this week's Merryn Talks Money. If you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending your questions and your comments to merrynmoney@bloomberg.net. You can also follow me and John on Twitter or X. I'm at MerrynSW, and John is John_Stepek. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sam Asadi and Moses Andam. Sound design by Blake Maples, and special thanks, of course, to Simon French.